What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on our broad market. We've got our core list of companies, some of which are reporting earnings this week. And then I've got 3 additional trade ideas to share with you towards the end of the video, so definitely stay tuned for that. Obviously, the broad market took a huge beating this week. Netflix, of course, the big one as well to talk about, so we'll get to all of that. Before we do, I would just remind you that we do have all of our links down below in the description for anything we're associated with, and without further ado, let's jump right into these charts. So kicking things off on our SPY weekly chart, talking about candle structure and location as we always do, they made it really easy for me this week. Obviously, we have a full-bodied red candle, so all I had to do was draw a rectangle. Obviously, that would indicate that the sellers completely dominated the price action this week. There was no attempt from the buyers to put in an upper wick, and there was no attempt from the buyers to put in a lower wick. So complete domination from the sellers. This is all happening on an increase in volume as well, which is noteworthy given that we had a shortened trading week. And then perhaps the most important part here is location, right? There's 2 things I want to point out. If I do this, obviously we've firmly broken down underneath this prior resistance, which then offered support and support right here as well. So we're firmly underneath that. You could also read into that as the low end of the bull flag that looked something like this. But more importantly, and this is something that we've been talking about on the channel for what feels like ages, if we grab our support trend line and do something like this, remember what I've been saying for the past number of weeks here. We're only going to get bearish in the S&P 500 when this breaks, and it did finally break during last week's session. So does that mean to have a more bearish outlook in the marketplace right now? I would say yeah, that is a valid point. However, I wouldn't get overly bearish just yet, and I'll describe why as we get down to the daily time frame. So again, this doesn't mean just because it's broken, go out there and short it first thing on Monday morning, expecting the market to go to 400 or below. Now, could that happen? Sure, anything can always happen in the marketplace, but there are some things that I'm seeing that may point to a bit of a dead cat bounce first, and again, we'll get to that in just a second. Before we go to the daily, I would also remind you that on 2 p.m., or rather at 2 p.m. on Wednesday, our good friend Jerome Powell will be discussing the FOMC meeting minutes during his conference. So I think a likely scenario may be that the market holds its breath here and then reacts on Wednesday once we get that news from the Fed. So again, just speculation there. I'm not saying it has to happen that way, but it could be in the cards, and I wouldn't be surprised if it happened. The next thing I would point out from the weekly before we drill down is just our next support. Where is that coming from? The lows of the wicks right here, close to about 430, 428-ish area is the next big sort of milestone to achieve to the downside. And then the last thing, I suppose there was 2 things, apologies for that. I'll take out the trendline tool just to use the measuring as a measuring stick, right? Look at that little information box. As of right now, we have pulled back 8.81% off of the all-time high. If the market's going to do what it traditionally does once it's surpassed a 5% pullback, which is go to the next big milestone, 10%, where does 10% take us? Well, would you look at that? Roughly the lows we just pointed out around 428. So do I think it's in the cards for this week? Yeah, it definitely could be, and it wouldn't be unreasonable to start moving into these weekly lows. So that's going to do it truly this time around. Let's go to the daily and start talking about tradable levels into the upcoming week and why I don't necessarily think you should get bearish right out of the gate. So obviously we have this support trend line no longer valid. I'm going to remove it. Our resistance trend line is now coming from here. There's your first touch on the lower high bounce. And look at how far we've traveled, okay? And this is why I don't think it would be wise to just immediately start shorting on Monday morning. Now, if your time horizon's long enough and you can afford to sit through some volatility that may look something like this, that's fine. But for you short-term traders, it's starting to feel, and again, I use the word feel very intentionally because the market can always feel whatever type of way you want. It's starting to feel a bit overdone. We're dramatically extended through the 200 SMA. Usually the first touch is the best touch, and it didn't really provide much support. Sure, there was an intraday bounce, that's fine, but we definitely did close underneath it. So given the nature of how we've arrived where we're at, that's why I would say be careful out of the gates for just chasing this thing short. There is still a ton of volatility in this marketplace, which we should point out as well. Let's just quickly take a look at the VIX. Here we go. it's creeping up towards that 30 handle, right? And we know that that's a big deal. As we get towards 30 and above, we know that generally speaking, volatility can't truly sustain up there for a long period of time. This is a mean reverting type of asset. So again, that's another sort of indication that, hey, maybe it's not wise to start chasing the short dead on the lows. Maybe wait for an acceptable pattern to go short before just chasing it here, which is sort of what I was alluding to with the market being patient on Monday and Tuesday. If we were to put in a bear flag down here, then by all means, looking for breakdowns underneath these lows to continue on our merry way lower. But until that consolidation happens, until that pattern unfolds, I don't think it's wise to be chasing it short here. And again, don't confuse that with just saying, okay, then it's got to be long. That's not how it works. I think patience is the play. Don't chase it short, but it's also not just an easy long at this point in time. So that's what I'm seeing from the daily, the weekly, the VIX, which we just discussed. While we're sort of getting through the internals, I may as well bring up the S&P sectors here. We're still getting defensive posturing. That shouldn't come as a surprise to anyone. We've talked about this for weeks on end. Staples, real estate, utilities, I mean, all of that stuff leading the pack. And by leading, I just mean being down the least. It's just all defensive posturing, so this should not come as a surprise. If there is any sort of dead cat bounce, what's that area to look for? Well, as we pointed out from the weekly, this area, the low end of the consolidation that we had up here, is roughly 450.75, 450.50, 450 even if you like, just nice round numbers. I would be watching out for that to be the most significant overhead resistance if there is any sort of upturn. If we consolidate and just go sideways and then we start breaking down under lows, we do have this gap to fill, which is going to be down at 436 even. And then we have an intermediate support here. This is not the strongest thing in the world. It's just something I want to have on my radar at 433. And then those levels we discussed from the weekly at 428.50, which is roughly completing the 10% pullback from highs all the way down to the lows. So those are the numbers I'm watching in the S&P 500. Obviously, we just are completely falling off a cliff here. There's no real pattern to discuss. The last thing I'll bring up is the Fibonacci's. If we come from the top, not stop, of that move there to the low where we're currently at, look at that. Thing of beauty. Again, I literally cannot make this stuff up. I don't make the charts. The price action dictates itself. The 38.2 is perfectly coinciding with that 450 area. So any bounces that do something like this, it's nothing more than a bear flag consolidation. We know the weekly is bearish. We're underneath the support trend line. You get the gist, right? Hopefully you can see. I think it's a patience play, not just an immediate short on the Monday morning session. The last thing I'll do for our S&P 500 is come on over to our market profile. If you're not familiar with this software, I've got a video in the top right-hand corner that's going to describe what this is and some of the terminology I'm using. However, for those of you who are well-versed, look at what happened on Friday's session. On Thursday, we know we had a spike, right? That was no big surprise. What's interesting is that we went into the spike, so you can see that here, into the spike, and then we sort of chopped around, but never even came to the top of the spike closer to 45.30. Just another bearish indication for the short term, that is. It's not to say, again, that it can't go higher than there or get to that 450 on the SPY. I'm just saying, from a more nuanced perspective, we didn't even make it to the top of the spike. So the sellers, they are truly strong here. The last thing I would point out from the market profile is sort of conflicting with that. And it's good to look at all of the data points, right? And just sort of weigh all of these things equally. Look at your point of control. Higher on the Thursday session and more middling on the Friday session. Another reason why I don't think you should chase it short on the Monday open, simply because the nature of where the most volume was transacted is still higher up in the last two profiles instead of being dead on the lows, close to where we've closed. So that's all I've got for you in the market profile. Let's go back on over to the platform and round out the broad market here with our QQQ. And when our levels load, what we'll notice, of course, is our support trend line has been broken, right? That shouldn't be a surprise. We will remove that for clarity's sake. And in this one, let's see where we're at in terms of pullback already. Again, I haven't measured this one, so we'll just quickly see. Off the all-time high to where we're at currently, we're looking at a move of minus 14%. So relative weakness to your S&P 500, no doubt about that. We know that the interest rate sort of rising has not boded well for tech. So again, it shouldn't come as a big deal there. But where we're at is, again, another reason I don't think it's just a blind short Monday morning. Look at how we're kind of getting overextended through the 200 SMA and coming slamming into this area of support here. I do think that it wouldn't be unreasonable for a little bit of consolidation, put in a bear bear flag, that's fine, and then we continue on our merry way. Generally speaking, markets don't move in straight lines. We know that, right? So I don't think it moves in a straight line to the downside either. Now, it's easier to move in a straight line to the downside because of panic and fear, of course, but at some point there needs to be a little bit of equilibrium where the market catches a bit of a footing. Even if it's just for a day or two, I think that's the likely and more risk-friendly way to approach this to the downside. I don't think chasing it, as I've hammered home now, I don't think chasing it is a good thing. So that's what I've got for you on the QQQ in terms of where we're at location-wise. The next stop underneath is close to 341.25. Why is that the number? If I scrunch it up, prior breakout point, simple as that, then holding it as support for that little consolidation before the next leg higher. As we know, again, during this leg higher, as it was moving, right, there's very little market structure in there. So this could happen sooner than later after a bit of consolidation, as I've sort of been alluding to. Again, 341.25. Underneath that, be prepared. I think there's some more room to fall here. I'm not saying the gaps will immediately be the targets, but you can see that this is just really choppy. Those are the big numbers to watch out for, close to, what's that, 324 roughly here for the gap, and then obviously this pullback low around 315. Again, I'm not saying it happens this upcoming week, but I'm just pointing out that there's not a great amount of structure underneath us in the QQQ. If there's going to be a turnaround, just like in our S&P 500, where's the back test level? It's here at 369. Why is that? Well, there's your support from once, break through it on the equal low, boom. So to me, it's all about the back test of that area. Let's coincidentally see how the Fibonacci's line up for this one, coming in from our high down to the low, and would you look at that? Again, it's close enough here. The 38.2 is essentially coinciding. So anything that happens in here, remember, is technically a bear flag. Forming something like this, then we can look for lower. So that's what we've got in the QQQ, a similar picture to the S&P 500, but I did want to give you the numbers. And then next up, we have the IWM, again, perhaps the most bearish indication of them all. We discussed this in the midweek market update on Wednesday. Let me grab some more time so we can just see this relative to where we're headed. I mean, we fell out of this big area. We talked about for a long, long time that anything underneath 208 is a massive red flag for your marketplace, and obviously that is starting to unfold on an increase in volume. So this alone is probably enough as well to start saying, hey, I don't really think now is the time for longs, new longs yet, inside of our marketplace until the IWM either starts to form a base or some sort of bullish pattern, be it a double bottom, be it some sort of inverted head and shoulders over time. And it doesn't have to happen where I'm drawing it. I'm just speaking out loud. So that's what I'm thinking here. This is a huge risk-off indication, which again supports the theory that, hey, we should start looking for shorts in our other marketplace instead of being so optimistic as we were prior. So what do we have for numbers here in the IWM? Well, again, not much structure in this move that's straight up. I've sort of pinpointed some of the areas that I want you to focus on, and I'm just illustrating them by zooming in here. You can see resistance, 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 all of these touches, then support. Resistance, 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 then support, and support right here. And again, same sort of deal right there. So those two numbers are 198, three numbers, 198, 191, and then 184.50. Let me scrunch the chart back up and bring us over to where we're at currently, just so you can get the sense for where we are relative to them. We are through the 198. This wouldn't be unreasonable this week, again, after some sort of consolidation, then continuation, and the same thing with 185. Definitely could be on the table for this upcoming week. In terms of just being congruent with everything we're doing so far, let's quickly get the sense for how far this is off of its all-time highs with our measuring stick. Then we'll get on to our broad market. Core list of companies. I know this one has been a little bit long here. So we're looking at almost a 20% pullback off of the highs in IWM. Even if you were to just measure it from the more recent sort of downturn from here, something like that, that's still 13% to the downside. So not really a good look for small caps or generally risk on in the marketplace. Obviously, if there's a bounce, it's all eyes on 208 for the back test here. That should be a no-brainer. That's all I've got for you in the IWM. Let's get to these companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. Kicking off our companies here with Apple, this one is certainly cementing itself in a downtrend with a lower high here and now finally a new lower low. Again, short-term downtrend is definitely in effect. The one interesting thing about this is, of course, the fact that we have earnings coming up around the corner. Here's my general sentiment for earnings as we're moving forward. We'll talk about this on Netflix in a second too here. And by no means am I the first one to sort of come up with this theory, but good earnings, so let's just put G for good earnings, in this market environment, so we'll put market for 2022, will mean a flat, so F for flat, price movement. I think even if you have good earnings right now, it's not going to do a whole lot to get you out of the woods. If you have bad earnings in a 2022 market like we've been experiencing so far, and we'll see this on Netflix, the big drama there, then you are going to get absolutely O for obliterated. It's going to be no good for your company if you report bad earnings in this market environment. Again, I'm not saying I'm a genius for thinking this up, but I'm just saying that's kind of the condition that we're in right now. So be aware that Apple, even if the earnings are fantastic, don't start thinking, oh, why is this not higher than it should be? Or like, why didn't this go to the moon, quote unquote? It's just not the right market environment for those types of things to be happening right now. So with all of that being said, again, I don't think that this is just an easy short here now that we're cementing the downtrend, given our trade location, given the fact that we're down like basically 1, 2, 3, 4, 5 days in a row almost with the FOMC coming out, with the earnings announcement coming out. This is a tricky one, and it's going to be a tricky one to trade. I would probably rely on intraday setups only. I would say that we're underneath this level of support at 164.25, and it doesn't really leave a whole lot below until we get to 157 coming from this prior high, which then offered some support in here. So maybe it does open the gates for lower, but I still wouldn't be chasing it short unless there's a clear intraday setup where you can say, okay, I know my risk is here. Maybe we get a back test of 168. You can short against that, right? Looking for the rollover equal low and then 157. That's probably how I would start to approach this. The other scenario, the bullish scenario, let's just say that earnings are fantastic and it is enough to keep it flat or maybe even a little bit higher. Here's what we have, right? We had this range, we played ping pong. If this is going to be a look below and fail, it's the recapture of 168. What's the target going to be? Technically, it should be the top of the range, but given the market conditions right now, I wouldn't be overly optimistic. I would really watch for the lower high at 177.50. Let's move along and talk about the travesty that was Netflix. I mean, this thing got absolutely smoked on Friday on the earnings announcement. And you can just see this sort of trend down here. It went from $3.19 a share, and we reported this prior cycle $1.33. So we're falling off instead of keeping up those great numbers. I mean, it just wasn't as bullish as analysts expected. And obviously, the thing took a massive beating for that, which is tying into that theory, which I outlined on the Apple chart, right? So we're underneath now all of this, like multi-year consolidation in here. This was nothing more than a fake out, apparently. Again, there was plenty of money to be made on the long side if you sold or up here, whatever. I'm not talking about that. But anyone who was just holding the position is now feeling some pain. And we just went sideways on Friday. There wasn't really too much activity. So what we're going to do is just point out broad areas to pay attention to. Underneath the low, we have this area of support from the daily time frame chart at 357.15. It's coming from, if I zoom in here, you can see all of these interactions for support, a little bit of chop, and then support here as well before that run really came. The next area, this resistance, is also coincidentally the low of Friday. We'll talk about that as we get over to the more recent price history. And then we have this 296.36 down towards the bottom, just simply coming from resistance, 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 support, and support here as well. So those are the numbers I have to the downside. And if we get back on over to where we currently are trading, again, what you'll notice is that's the dead low of Friday. I think it's patience in here. Don't get me wrong, there will be some day trades in there, but for the longer term direction to really unfold, it's got to be into the gap overhead. This is a 50% gap fill, by the way, at 454.10, and then after that, the full gap fill would be up closer to 500. We'll talk, one step at a time here. Obviously, this was incredibly bearish and damaging for the chart. And then to the downside, again, if it breaks Friday's low, that's where those numbers are coming from. Once again, 357.15 and 296.36. Maybe it's 300, just the psychological number as well. So Netflix is a tremendous patience play. I don't really think that we have direction yet. Day trades only is sort of what I'll stick to there. Tesla is up next. And again, I'm leaving some of these charts on higher time frames just so we can see where we're at in relationship to support trend lines. The next level's up underneath. This one certainly did fill the gap on Friday, which we discussed on the secondary channel as being a likely scenario. We also talked about it on the midweek market update on Wednesday. Regardless, it's back down underneath 1,000, big red-bodied candle. We're coming into this prior area of support, not only from here, but it was the prior all-time highs. Remember that zone here, close to 900. You get the gist. I do think that there is possibility for it to have some sort of rally out of this on the first touch, and then it's all about 1,000. Do we get to 1,000 to backtest it? If so, fine. Maybe that's a little bit more bullish than bearish. If we fall short and do something like this and turn around immediately, never make it to 1,000, that's much more bearish than bullish, obviously, right? So that's how I'm thinking about Tesla. There is room to fall. I wouldn't be surprised if it does make this descent into this general area, and then we'll reevaluate the dead cat if it happens, or if it just blasts right through, that's where it starts to get into, once again, the no chase zone for me at least. So that's what I'm seeing here. Anything north of 1,000, 1065 is the magical number we've been discussing for quite some time. Anything underneath 900, we have this little baby shelf of support around 855. I wouldn't read into that too much, but instead the big breakout point from here and the nice round number 800 psychological. 200 SMA is down there currently. We'll see if it comes into play. Obviously, just like Apple, earnings will be a wrench thrown in the mix here, so take all of the levels I've said with a grain of salt. Next up, we have Alibaba. Zooming in on this one, again, surprising relative strength here, right? So it's really just kind of hanging sideways instead of completely falling apart. Don't get me wrong, it was bearish Thursday, Friday, but it's not like we're making new lows as many of our other companies are. So with all of that being said, we have this level at 124. If the rest of the broader marketplace sees even a little bit of an uptick, I think Alibaba does something like this back to 130, and then we get chop around this area. We can see it's just a high volatility area. I wouldn't be too overly convicted one way or another. If we get there, I would be patient, right? This is really enter here, take off the trade here, reevaluate for the next setup after that. If we get to here, then maybe it's a short back down towards the midpoint, right? You're just treating this as an overall range. As we know, the midpoint is really never the place where you want to start getting new positions initialized. So that's what I'm seeing in Alibaba. If it falls out to the downside, and obviously the market does continue to fall apart and descent, you're looking at 115.85, basically the lows of those two hammers, and then the big lows here at 110. Again, Alibaba, the pattern's not abundantly clear, but it is showing a little bit of relative strength, which is why I would look out for any little dead cat bounces here to do something like that early on in the week. Next up, we have Facebook. This one is falling out of bed as well. Earnings a little bit further out, not a big concern on this one, at least into this upcoming week. What you'll notice is that we're underneath this area of support, firmly closing a candle well underneath 310. The next level is here, 298.75, 300 psychological. And once again, just like a majority of our companies, if we continue this descent, all of this is now overhead supply. They're feeling some pain. It's not looking so hot. So what's the next level underneath? Well, looking left, it's got quite a ways to fall underneath 300, all the way close to 279 coming from. Break, retest, pullback held there at 280. It was also prior resistance from in the past, right? You can see all of that on the left-hand side of the screen. So Facebook is, again, nothing's looking overly bullish right now, but I still don't think that it's, just an easy short here, given the nature of how we've arrived where we're at. A bit of a bear flag would be nice first. Risk-friendly entry sets up with a lower high we can trade against. Stop loss goes here, flush of the lows, brings us to those lower targets. That's how I'm approaching many of these setups that we've been discussing so far today. NVIDIA is up next, and this one, if we zoom in here, the dominant support trend line's coming from way back there. I don't necessarily think it'll be in play. I think the 200 SMA may give us a little bit of something first, or just some of these horizontal areas. I would also point out that the gap did fill from right around in here. That's a structurally healthy thing, but it's not necessarily like an overly bullish indication, right? The structure on Friday would be an inverted hammer, which would indicate the sellers way overpowered the bulls as we started making our way towards the 50% of the prior day's range. Just not that exciting, again, because of that, actually. So let's talk about this nuance as well. This is basically a dead cat bounce. Although it's not a green candle on our daily bar, the buyers certainly had their stab there to take it higher. So is that a day of consolidation? I would certainly start to think of it like that, given what unfolded there in the transaction between the buyer and seller. So if this just has another day or two and then breaks, it's not something that I would feel like is chasing based on that interaction right there. So that's what I've got for you inside of NVIDIA. Downside levels, again, are 200 SMA, 219.50 coming from this area right here. Next up after that is this support and prior resistance around 207. If there's a larger bounce in NVIDIA, again, I really don't think it's an easy long until we start recapturing that level there at 272.25. Let's just quickly take out our Fibonacci's just to see where that aligns. Again, it's pretty far up. Yeah, so that's not really going to help us out too much. Let's come in from here just to check on that move. Yeah, I mean, it's close. It's the 38.2 there, but that's a little bit of a stretch in my imagination there to make that, be valid. I would just rather rely on this as being structure and saying, okay, any bounces that recapture that, maybe it starts to change the tone inside of NVIDIA. But until that happens, again, I would be skeptical and looking for bounces to short into on equal lows after a lower high, anything underneath 272.25. Next up, we have Microsoft. Zooming in on this guy, what we'll notice is we're kind of close to that 200 SMA. So to me, this may be a candidate for a bounce. The one thing that I would say about this is look at the fact that we did get the consolidation already. I wouldn't be surprised if this does continue based on the fact that we've had that consolidation, right? A lot of other things we've seen so far don't have that period of let's catch our breath for the sellers. Microsoft does have that. So maybe there's a chance for it to move lower immediately instead of pausing a little bit. So 200 SMA in this horizontal level is the only saving grace, 293.50. If it breaks, you have this big set of lows, almost similar to what we had in the SPY, close to 281.50. Underneath that, littler set of lows here at 275. That's probably what I would look for into the upcoming week. Obviously, earnings, again, will be a big deal on this one, something that you should pay attention to. Good earnings will be flat. Bad earnings will be punished. To the upside, if this turns around, just like we talked about in NVIDIA, the level to get re-involved to the long side is 311. Now, why is that? Well, simply because prior resistance, then turned to support, and then turned to resistance yet again. So if we can do something like this and then clear it, that does open the gates up to at least 318. You can see that's a flush point as well, and we'll take it bar by bar. Obviously, everything is skewing a little bit more bearish, so don't overstay your welcome on the long side. Last but not least, we have Amazon, and this is very similar to IWM in the sense that we had this huge area of consolidation, accumulation, whatever, people trading back and forth. Some of it's distribution, don't get me wrong, but some of it's also accumulation, falling out of that. So big deal here inside of Amazon, and I really do think this has the potential to really harm the NASDAQ 100 and even the S&Ps, but more importantly, tech, right? So underneath this 2878, that's kind of like the line in the sand. You can see we did close the bar on Friday underneath. Is it a little overextended? Yeah, I wouldn't be chasing this one short just yet. Maybe we get a little bit of a snapback, but as long as we remain underneath 3027, 3000 even, doing something like this, nothing more than a bear flag. Eventually the break of 2878 should bring us lower, closer to 2667 quarter. You can shave off the pennies there, obviously, on a $3,000 stock. And then the next big area of support is coming from this breakout zone at 2466. It's been a long time since we tested that number. Obviously going sideways here, we could get a lot nastier than what we've already seen, right? All of this is the overhead supply theory that we discuss here. Could this just be the beginning of Amazon falling apart? It very well could be. I'm not here to say that it goes to zero or anything like that, but this could just be the beginning of what is yet to come. So that's what we've got in Amazon to the downside. If it turns around, we talked about 3,000, 3027. The only way to get bullish on Amazon is a recapture of 3176. Why is that the number? Simply coming from the prior double bottom right here, hammer candle, lower high, and then it all really fell apart from that. So 3176 is your green light in Amazon if it gets back above, but as we've been stating and what the chart looks like, it doesn't look like it's happening anytime soon. So that's our companies in a nutshell. I know we spent a lot of time on them today, but there's a lot to be thinking about here now that the market tone is starting to shift. Quick reminder to hit the thumbs up button, subscribe to the channel, hit the bell button, all of that good stuff YouTube tells us to tell you guys. And let's get right into these trade ideas. First one is going to be on MU for Micron. And the reason I like this is because it's feeling a little overextended and it's coming slamming into this horizontal area of support around 80.63 and the daily 200 SMA. Now, does it guarantee that there's a bounce here? No, it doesn't guarantee it. But if you're someone who likes to take a little bit of risk in the marketplace and thinks that, hey, things are getting a little bit overdone, it would make sense to me that maybe there's a chance for a long opportunity here for just a little bit of a dead cat bounce. We take our profits and move along. Stop loss has to go here, and you have to be disciplined about it, especially in a setup like this where we're quote unquote trying to catch the falling knife. So if you don't have discipline, if you found yourself blowing up accounts in the past because you can't stop out of a position, this is not the trade for you. And I wanted to give you that disclaimer here because, again, this could easily blow up in your face trying to catch a bottom. I just like it because of the structure that we're coming into and the fact that it's starting to feel a little bit overcooked here. So that's what I've got for you in MU. Next up is going to be on GM. Very similar idea. However, this has a short setup as well. Earnings are this, I believe it's this week, unless the 31st. No, okay, I'm sorry. They're next week. So no big deal on earnings yet. But here's the two setups, right? Obviously, 100% retracement. We've talked about how in the past that generally speaking does not just immediately take out the low and continue. Generally, we get some sort of dead cat bounce. So that's going to give us an opportunity. If you're someone who likes to trade long, then again, you're trying to catch a falling knife, so discipline is required. You could look for the bounce and try to capitalize on it. Or if you're more comfortable shorting, going with the direction of the marketplace, wait for a lower high, and then the turnaround, equal low, breakdowns take us to 48 quarter. Let's just quickly see where an acceptable lower high would come from, coming from the top down to the low in here. So anything that's essentially underneath 58.65 does set up the potential for an H pattern, bear flag, whatever you want to call it, and then the breakdown from here. You get even if you're a more aggressive short trader, if you start seeing inverted hammers up here, or it could be off by a couple dollars, a penny or so, that's fine. Then if you see this, then stop loss goes over the highs, looking for shorts on breakdowns under the lows, and then you get the move to the base and then potentially monitor for continuation into this shelf from in here. So just a number of ways to approach it, but another opportunity here presenting itself inside of GM. Next and lastly, we have TSM, and this one again is looking for a long-sided setup in a falling marketplace. So please, if you don't have discipline, this is not the setup for you. This is pulling back aggressively. Honestly, earnings were a big blowout number. Good things happen there, new all-time high, that's great. But look at what we're pulling back into, this big area of structure coming from like a multi-month consolidation period. So this is not something that you just immediately long down here, but if we're gonna start getting some sort of either double bottom with a nice higher low for the second touch there, break of the neckline could take you back higher. Something that looks like this, a fake breakdown further into the range for a head and shoulders, right? There you go. Break of the neckline takes you back higher. I'm just thinking about the structure and the location of TSM right now. I don't necessarily think that this is the equivalent of MU or GM. Those are much more scalpable in my estimation. This structure here may take a little bit longer to play out given the nature of the size of the range, as well as the fact that this was such a historical area that really took some time to resolve. So that's what I've got for you. I do think it's a careful, maybe not a careful, but it's going to be a tricky market to be navigating, so please be careful. That's the wording I was looking for out there. There's nothing wrong with sitting out, right? If you're not comfortable with chasing this to the downside or trying to get involved to the downside just yet, that's fine. There's nothing saying that you have to show up to the desk and you have to put on a trade. You can sit there, you can observe the action, and then make an informed decision. So please don't feel pressured to just immediately flip bearish if that's not in your trader psychology. Be aware of that type of stuff. So all of that being said, I know today's video was a lot, but things are changing in the market and we need to address them, and that's going to wrap it up here. So if you enjoyed the video or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked down below in the description, where we do 10 to 12 video ideas every single day. That's not week, that's day. And with all of that being said, I wish you a green trading week.